Hello and welcome back to our weekly market recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. So this past week, we saw the market up 1.8%. That means we're down on the year only 1.5%, down from the highs in February 5.9%, but up from the lows in March 42.3%. So this past week, we ended the week off positive and mostly around, again, some more positive coronavirus news, this coming from Gilead again and the remdesivir drug. We also want to talk about where we are within the market year to date and some of the tech stocks that we've seen in the Nasdaq, again, hitting all-time highs again, and basically all the FANG stocks reaching all-time highs intraday during this week. So, Rich, do you want to talk about Gilead and to start off?
Yes. Well, we had some really great news from Gilead. The research and actual cases have shown that Gilead remdesivir is good at preventing people from dying from COVID-19. That's a huge win because that means that we now have at least one drug in place that can help minimize the deadliest effect of COVID-19, which is death.
Yeah, and obviously the market reacted extremely positively. We started off Friday's trading session down and wound up after this news up, 300 points in the Dow and up across all three indices, major indices. So this is game-changing. I think one of the things that makes this so life-changing as well, besides its just effects, is it's already been FDA approved. It's already so far along in all of its approval processes. We don't have to wait till next year. We can start, again, prescribing the drug and using it right now. I know it's already being more mass-produced, and there's talks. Now, we don't want to get too lost in what the drug prices could be. I know there's been a lot of drama surrounding that. But overall, for the market and for what we're seeing, and most importantly for the mortality rate of this disease, this has huge impacts that could drastically change the landscape of this pandemic.
Exactly.
Yeah, and then the other kind of couple pieces we wanted to talk about was Nasdaq reaching all-time highs again, and tech specifically. Rich and I were talking about this all throughout this week, and we kind of have two slightly differing opinions or different thoughts on it. But I'm of the camp that tech. What we're seeing in this is a lot of people are wondering: do we see a bubble right now? Is tech too high? And my personal thoughts are, tech used to be one of the riskiest sectors. People were afraid to invest in tech because it is very growth oriented. They're not known for paying out dividends. They're not known for giving a ton of their capital back. They normally reinvest in their companies. So you're investing on growth portions of it. And that inherently has in the past made tech a riskier sector. What we're seeing now is tech is actually becoming the safe haven, at least during the coronavirus pandemic, and really, in a lot of ways, one of the safest sectors for the past 10 years. So I think partly what we've seen and partly what supports this high price level is people are actually fleeing to tech in order for the safety of the continuous ability to be profitable in these uncertain times. But Rich did have a couple other points that he wanted to say on it.
Yes. Well, one of the things that we're seeing with the entire tech market is that COVID-19 has really been a test as to the resiliency and the ability of the companies to show the future. And we've had a greater change of people spending more time, whether it's on Zoom, whether it's buying online, and keeping away from retail. The great example is this week, Brooks Brothers declared bankruptcy, and they've been in existence since 1818. They have a good retail section, that's online, but most of their sales dealt with brick and mortar, and people aren't going into those buildings. They had employees all over. And as a result, they're now seeking Chapter 11 protection. So the hype around a lot of these companies is coming true, that they actually are going to do well, and the new economy post COVID-19 is going to have a lot more people buying online, and there's going to be a lot more issues around brick and mortar purchases from retail sales.
Yeah. Well, thank you, Rich, for your thoughts. So I guess both of us then support the claims that at least the current price levels, there is some support for the run-up that we've seen in tech, and we might continue again to see this run-up continue depending on really what massive changes continued this post-coronavirus pandemic. It's very likely we're going to see changes. We've constantly have seen it, and we might never be the same, at least when it comes to the retail space. The last thing that Rich really wanted to mention is we're down 1.5% in the market year to date. What does that mean for you? What does that mean for your portfolios and the volatility that we've seen?
In addition, it also reflects the strategy that we've been using. When the markets went down, we did a lot of tax loss harvesting. We reinvested so that your accounts could go up as we knew the market was going to go back up. And even though we've had basically almost a very flat year, if we were talking without all the volatility and just saying that here we are on July 10th and the market's down 1.5%, people would be yawning. There'd be nothing to talk about. It's the great volatility we've had in between that has made this so important. And the fact that we've been able to take tax losses for you in your accounts and then reinvest to match up what the pandemic has done so that your accounts will do better has really paid off for you. And we're actually very proud of what we've been doing and how we've been keeping on top of this to protect your financial interests.
Yeah, I think that's very important. It is, the volatility does bring up different things and different emotions, and being able to navigate that and stay invested, it's something that we've really appreciated about our clients, you all who are watching this, and being able to ride through this with us. And you have been rewarded for staying in the market. You have been rewarded for sticking the course, because as we see, as Rich said, if we just completely ignored everything else and looked from January to now, and we said your accounts, the market as a whole, not even maybe your individual accounts, were down 1.5%, we wouldn't be having this conversation. But because we did see the drop 33%, we have seen the rise 42%, we are talking about it, and we will continue. But what's really important is to notice, how did it feel when the market dropped that much? What are the things that we've now learned from this situation to be better equipped to handle the next one? Because we are going to see another market drop sometime in the future. We don't know exactly when, we don't know how soon, how far, but really noticing and learning and Rolodexing this event for the future.
Great point, Knight. Thank you.
Yeah, well, we'd like to end as we end it all. Your money is meant to support you. We are meant to support you. We have so much joy connecting with all of you, and keep staying safe out there. We had some really positive news this week, and we'll see you again next week.